Hi, my name's Edward Sapp from Sapp Capital Advisors, and my day job is building big advanced Excel calculators for hedge funds and private investors to underwrite commercial real estate. These are models where I take every input imaginable, put it in, and then it spits out an answer of how much profit and return you're going to make. So I thought I'd take those practices that I have for my day job and apply them to my personal practice of buying a house. I currently rent, and so I have a scenario in which I'm paying rent and I'm paying my renter's insurance, but I also am considering buying a place. I have an offer accepted on a place, so this calculator served its purpose of getting me to a decision. But what was missing from my last video, and what I actually ended up doing the full math on before putting my offer out, was the tax savings question. So I left that as one open item at the end of the last video that I put out on this. But in this model, you can actually see that I have built in the logic for the annual savings on my taxes when I buy a home. And you'll see in a second how much that amounts to and how you can repurpose this calculator for your own personal needs. So I'm going to assume you saw the first video where I walked through how much I was paying. I've got almost 100,000 down on this house. My monthly cost comparison between renting, 2.3K per month, and buying, which is 2.9K per month after tax savings, or 3.5K per month before tax savings. But it's important that we factor in the tax savings. So let's back it up. So comparing just renting and buying while including this tax savings number, which I'll get to in a second, the comparison on a dollars out every month basis is 2.3K renting, 2.9K buying, adjusted for the tax savings. Every month you'll actually be putting out 3.4K, but when you get the write-offs, that's when the tax savings come through. So cash for a full year perspective, 2.3 versus 2.9. Now, when you rent and you stop renting, you don't own anything. When you buy, you're actually paying a bit of amortization every month. So you do walk away with an asset that you slightly do own. So you can't just compare the value of renting and buying. And when I say slightly do own, I am assuming a 5-year hold period as covered in the last video. So how did I first compare these two scenarios? I compared the simple profit of either scenario. So you have cash flows going out and cash flows coming in. Well, you can see big news with the tax savings is that on a simple profit basis, the homeownership scenario is actually more profitable than the rental scenario over a 5-year period. Why 5-year period? Because I probably won't want to live in this place when I'm 5 years older than I currently am, but for the next 5 years, it makes good sense to live there, and maybe I will want to stay. I'm not going to force myself to leave. So with the tax savings factored in, I'm actually in a more profitable position to own this house. Not even factoring in to the account that this place that I'm buying would probably rent for $2,500. So if you adjust for that, it's an even more profitable choice. If you truly price in the lifestyle upgrade, it could even rent for $3,000 when you look at comps. So you can just see the profit keeps going up when you compare it to more market-based comparables for the property that I'm moving into. But when you're considering leaving where I'm at now, which is in a slightly less desirable area, and moving into a more desirable area, it's still profitable, which is another green flag to have. So what exactly are these tax savings that I'm factoring in every year? Simply put, the standardized deduction when you file income taxes, or I guess just the standard deduction. I'm not an accountant. Take everything with a grain of salt. This is not financial advice, but it's something like $15,750 in this year, 2025. And so to not do the standard deduction, you should have things to write off that are greater than that. Right now, I have state income tax and charity in donations that would amount to a figure less than the standard deduction. Therefore, I don't have any excess. You can see this math right here. There's no excess over the standard deduction. So there's no positive benefit of that excess. However, in the buy scenario, I not only have my state income tax and my charity, I also have interest payments, and I also have property tax payments, which I can include, not HOA, I can't include that, or insurance, but I can include interest and property tax, which brings me to an itemized total of $44,471, which is $28,000 above the standard deduction. At my average all-in state and federal tax rate of 22.5%, I'll be experiencing an annual savings of $6,462 per year. Divided by 12, that is how I get to that 539 figure in the monthly tax savings. That's the logic. Now, obviously, the interest changes every year because you start to amortize the loan. So the amount that is interest changes, and the amount that is property tax will continue to grow into the future as they reassess your property. So what I have here is a changing number of the home ownership tax savings because you pay the most interest in that first year and then it slowly goes down. So I have a true loan schedule driving this model, and I also have my property taxes in this model being projected every year, which gets you into this line, which does represent the value of homeownership tax savings. I also have rental tax savings. If I were to change this number to say, oh, now I'm going to start donating even more to charity, they would show up in the rental scenario. The importance of that showing up in the rental scenario is so that your profit is valid when comparing rental versus buying scenarios. Both could have some level of standard deduction tax savings, which is really what this is calculating. It's not just calculating only in the buy scenario. So that's the punchline of what I've added to this model. And I went into the why it matters earlier in the video, but basically from a simple dollar perspective, my profit is better in the homeownership scenario with these, I would say, moderate assumptions. I don't have a crystal ball, so we'll check in on this video. If the Atlanta housing market tanks, then I'm eating it. But I think it's not aggressive right now to assume that things will slowly grow at a 3.5% rate compounded average over the next 5 years. So if there's a dip, there might be a rebound afterwards, and it averages out to 3.5%. The comparison period. So that's basically it. I already have the capital gains tax benefit factored into the buying scenario as well. And that might or might not apply to you, whether you already own a home. Hopefully you enjoy this. Comment below if you want a link to download this model. I'll send it your way. And I hope this makes sense. If nothing made sense, I'm happy to make a follow-up video and answer more questions. And also, I'll be active in the comments. Thank you.